Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 29th, 2023. Hope you're doing well, and thank you so much for coming and watching my weekend review of all the trades that I took last week. Hope you're doing well. Hope you are going to enjoy your weekend, and this is the format for today's podcast. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back and we're going to take a look at all the trades that I entered and exited last week, both on the daily and the weekly time frames. We're going to talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade going forward. How you manage the trade really is, in my opinion, is the difference between being a profitable trader and an unprofitable trader. So most of my work, most of my research in my trading process has gone into actually managing the trade. Of course, the entries, fairly simple, really, once you learn the process of how I trade. But how you manage it, that's where the rules come in, and taking half a position, scaling out on the way up. But I'll talk about all of that after I go through and review the trades. We are going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and follow the plan without letting your emotions get amplified because of gains or losses. Very important to just follow that plan. And in my opinion, that's how you get paid in this industry. After that, we are going to do a poem from my friend Frank, the trading poet, great author, great journalist, great musician. And he always writes poems that are pertinent to what's going on in the market, and there's some good trader psychology in there as well. After that, I have gone down through my master watch list, both on the daily and the weekly time frames, and I will highlight these potential trades that I'm looking for next week, both to the long side and to the short side. Most of the time when I go through these potential trades, they're not where the price is not where they need to be. They're not at the levels they need to be yet. So I'll identify what I'm looking for, what I need it to do next week, and on both the daily and the weekly time frames. Hopefully this gives you an idea of the levels that I look at and how I approach trading, and hopefully it will be helpful for you. It's always helpful for me. One of the reasons I do this podcast is it makes me be responsible, and every week have to go through and look at these levels very systematically so that I can present these on the podcast. But it's been a great trading week. We had a big 2-day rally on Thursday and Friday, had some great trades, exited some for small losses, which is the key to trading. When you have a trade and you're in and out, that if I'm in and out quickly, that means I had a loss, and that's good, because you want to be very impatient with your losses and you want to be very patient with your winners. And I've been in some of my winners here, some of them on the weeklies, for months and months and months, and that's the key. But when I'm wrong quick and I get out, and that's the key to profitable trading. So hopefully this podcast and this weekend review will be helpful for you. Let's get started. But before I do, I have to run the U.S. legal disclaimer, so hang tight for about 40 seconds, and I will be right back. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started. So in general, when I am taking a trade, in this case a long trade on AMD, just big picture, I am looking for the price to go down and reject a key level. That key level can be a 30 RSI level, it can be a 200 simple moving average, a 250 simple moving average, a 300 simple moving average. And that gives me a good risk reward ratio. At that point, I position size based upon the market's volatility, and I'll show you how I'll show you how I do that once we start. That tells me the right amount of shares to buy based upon my total capital and my total risk on any one trade. So after I figure out how many shares to buy, then I have two stops. I have an emergency stop. That's 2 ATRs below my entry. That's the worst case scenario. Secondly, I have a end of day stop. That's if the level of why I bought the trade in the first place, I had a level that was rejected, a key level that was rejected. If it rejects that back to the downside, then I get out quickly, hopefully for a small loss. Okay, so I always want to look at risk first, and that is position sizing properly, placing an emergency stop, having my end of day stop that hopefully is very close to where I bought the position in the first place. Okay, so those are all defensive moves based on risk management. Now, to the upside, if it moves my way, I always take partial profits. I take 10% of however many shares I have remaining if it moves up the value of 0.45 ATRs. And if it does, I put the limit order in the system. If it hits it the next day, 0.45 ATRs based upon the previous bar's close, then I take a partial profit. Okay. I also place a trailing stop level above my initial entry point, 1.5 ATRs above my initial entry point. If I get there, then I go into trailing stop mode, where if I get a close below a previous bar's low, I'm going to exit half of the position. So that's how I approach this. Look for a level, a key level that's rejected, position size, emergency stop, end of day stop. If it moves up 0.45 ATRs, I take partial profits. If it gets to 1.5 ATRs above my entry, I go into trailing stop mode. And then I have other rules as we go. Okay, so the key is looking for those key levels, position sizing correctly, getting out quickly if you're wrong, being patient, staying in the trade, and taking partial profits along the way. That's the offensive part of my approach. So with great sports teams, championship sports teams, they always have to play offense and defense. And in trading, it's the same way. I set it up where I play offense and defense. Get out quickly if I'm wrong, stay in, have a process to the upside. If I'm right, take partial profits as it moves up. That's the offensive part. And, just want to mention this at the beginning of the podcast that I do teach private one-on-one lessons in the evening time. I have been a full-time trader for over 28 years now. Can't believe it. It's been so long. I love to trade. I know how to trade, and I love to teach. I've taught people from all over the world. I do a one-on-one course in the evening time via Skype. If you're interested in studying with me and learning from me one-on-one, I will teach you everything that I know. And I've had such great reviews from all my students all over the world. So my email is in the link of this YouTube description. All you have to do is reach out to me, and we can get together, have an initial call, answer some of your questions. But it's a great course. It's worth every penny, and it's an investment in yourself. And I will teach you step by step all of the rules, because when we go through this today, you might think, oh, there's a lot of rules, and there are, but it's worth it. Having those rules, worth it as far as making a living trading. All right, so let's get started. Here is AMD. Okay, so I have been talking about AMD for a long time, and I guess this is a good time to mention that patience is extremely important in trading. Wait for the market to get to the level that you've identified. You don't have to do anything with that particular market until it gets there. And I have been talking about AMD for all the way up here. I was like, I want to buy it if it rejects the 300 SMA. So I've been talking about this for weeks. It never got there. It never got there. It did get there here on the 25th of April, but it closed under. So that's a no-go zone for me. But if you've been watching this podcast, I said, look, if I get a rejection of the 300, that is going to be my entry. Well, it finally got there on the 26th. So we closed under the 300, closed back over the 300. that was my entry. So I position size by taking my maximum allowed loss, and this is a function of your total capital. So a good rule of thumb is, let's just say you have a hypothetical $100,000 account. 1% of that is $1,000. Or if you have $50,000, 1% is $500. If you have $1,000,000, 1% is right is $10,000. So using the hypothetical $100,000 account, 1% is $1,000. I divide it by the value of the 2 ATR. That shows me how many shares to buy based upon the market's current volatility. So I did enter here at 85.67. Now, first thing, where's my emergency stop? Emergency stop is always going to be the value of the 2 ATR below your entry. So I take my entry minus the value of the 2 ATR, put it down here. That's my emergency stop. If it gets there, then I lose that hypothetical $1,000. Now, only about 5% of the time are you going to hit your emergency stop. 95% of the time, you're going to have an end-of-day stop. And an end-of-day stop is, why did I take the trade in the first place? Well, I took the trade because we had to close under and back over the 300-day moving average. If the next day it had closed below the 300, and by the way, I base everything on closing prices, because at the end of the day, the closing price is the most important price, then I would have simply have just gotten out. Now, my emergency stop is not based upon the close. If it ever got down to the emergency stop, then I get out the second it happens. Doesn't matter if it's 1 minute before the market or after the market opens, or 1 minute before the market closes, or right in the middle of the day. It doesn't matter, because if it does, because the way I've position size, if it does get down to that emergency stop, then because of the math, I've lost the $1,000. But luckily, that has not come into play. I bought here 85.67. The next day, you can see during the day it closed below the 300, but I wait for the end of the day, because the end of the day is the most important price, and it closed back over, still in the trade. Orange line up here, 1.5 ATRs above my entry. Once I get there, then I go into trailing stop mode. It had moved up. I did take a little profit here. I took a little profit on Friday to scale out, take advantage of the market moving my way. I've locked in those profits. Market can't take it away from me, and it reduces my risk going forward because I have taken some of that profit and my position size is reduced. So 1.5 ATR trailing stop level above here. Once I get to there, or if I do, hopefully, but if I don't, I don't. But once it gets to this level, then I go into trailing stop mode, which means then if I get a close below a previous bar's close, I will lock in half of the profit. So this trade doing very well in 2 days. Currently, this trade is up 4.15%. And, I attribute this gain here to patience, right? I was talking about it over here. I don't want to buy it over here. And a good thing I didn't. I said, look, if we reject this 300 SMA, that's my entry. And got this 85.86. Currently, it's 89.37. Like I said, up 4.15%. Great start to the trade. Now, here, earnings are on the 2nd of May. I never hold through earnings. So, not sure if AMD's earnings are in the morning or in the afternoon. I'll have to check that. But regardless, I will get, if they're in the morning, I will get out the previous days at the close. If they're in the afternoon, I will get out at the end of the day before the earnings. So I never hold through earnings. It's a great way to make a lot of money fast, but it's a great way to lose a lot of money quickly. You never quite know what's going to happen with earnings. So regardless of where this is, if it's up here or down here, it doesn't matter. I will exit this trade before earnings comes out, because as traders, our main focus to be risk managers, not put ourselves in a position where we could have a huge swing one way or the other, and holding through earnings is the best way to put yourself in a position where you could have a huge loss, and we don't want to do this as traders. So rejection of the 300-day moving average, moving up nicely, up 4.15%, and again, I will exit before earnings. XLE I took here on the 27th. Again, if you've been watching the podcast up here, I said, look, if we get down to the 200, which is the black line, if we get down here, I am going to buy it. Good thing I didn't buy up here. I was just patiently waiting for weeks for XLE to show me that it would reject the 200. It did. I could have bought it the day before with the rejection, but I didn't. I bought something else. But here on the 27th, which was Thursday, I bought it. And I bought it. Why? Because intraday we went, see how the day before we went below and closed above? That's legitimate. But the next day we went again below, closed above. So 2 days of rejection of the 200 SMA, which is important. And we also had a V1 entry trigger. So V1, V2 entry triggers are very big part of my trading. And I have a video on YouTube in my lessons playlist called V1, V2 entries. They make any trade better. I love them. I learned this from one of my mentors years ago by the name of Kerry Lavorne, and they make any trade better. And so, the main core reason that I took the trade was the intraday rejection of the 200, but also having a V1 adds a lot of bonus points and some sprinkles on this trade that help give me better odds that it's going to work in my favor. And a V1, for example, consists of two bars. Here's bar 1, here's bar 2. So you see how bar 2 went under bar 1's low and then closed above bar 1's close? That is a V1. But go into my lesson, the free lesson I have on YouTube, V1, V2 entries, and I think I do about an hour there on exactly what these are. They will help your trading, I promise you. So the main reason, rejection of the 200, cherry on top, V1 entry signal. I entered here on Thursday at 83.80. Of course, as usual, I place my I position size correctly by taking 1% of my capital, dividing by the value of the 2 ATR. It tells me how many shares to buy. I then use that same value and put the emergency stop 2 ATRs below so that if it does go and touch that, which I would get out right away, then I know exactly what my maximum allowed loss is, right? And if I'm okay with the maximum allowed loss, that's the worst that can happen, right? End of day stop. Well, why did I take the trade? I took the trade because the intraday rejection of the 200. So in the future, if it closes under the 200, I'm just out. That's it. So again, we have to focus on the risk side of things first. Now, talking about profits, I put my 1.5 ATR trailing stop level up here. 1.5 ATRs for my entry. That is my trailing stop level. If it gets there, then I go into trailing stop mode. And then again, if it moves up the value of 0.45 ATRs, in this case it's 76 cents, then I take off 10% into that strength. And that's what I did. So far, really great trade here. From entry to current price, up 1.56%. Not too bad for one day. All right. I do not only go long, I also do shorting quite a bit. This is UPS, and UPS, United Parcel Service, I did short this on Friday. Now, why did I short this? Well, we had earnings. I was just mentioning about holding through earnings. That can be a really bad idea. Well, if you held through earnings, before earnings, it was 195, and the next day after earnings at the close, it was 176. Then we went even lower. Yes, we have had a bit of a recovery here, but the 200-day moving average, the black line, if you're above the 200, that is acting as support. If you're below the 200, now it's acting as resistance above you. So do you see how we bounced? We went up, hit the 200, couldn't get above, and closed back below. That is my short position. It also happened inside this big bar here. That's another reason I took the trade. And so, yeah, I entered here short at 180.11. I position sized. I place my emergency stop above now because this is a short, 2 ATRs above. I place my trailing stop 1.5 ATRs below. And that's the trade. I've done the analysis. I position size correctly. I know exactly what I'm going to do. If it closes back above the 200, then I just simply get out because now the 200 is acting as support below me. If I'm short, I want the resistance above me. So this trade is, let's see. This trade is already in the money. about 0.16%. Not a lot, but I just barely took the trade. So that's it. Rejected the 200 above me inside this big bar. Place emergency position size. Place the emergency stop 2 ATRs above. If it closes above the 200, I hope I simply get out. Right? If Monday, if it closes above 200, I simply get out, hopefully for a small loss. If I'm correct and it starts moving down, then I'm going to take partial profits, 10% partial profits, if it moves the value of 0.45 ATRs to the downside. So just to show you here, you can see the reading of 0.45 is $1.89. So it closed at 179.82 minus 189 to the downside because I'm short. If it gets down there anytime during the day on Monday, then I'm going to take off 10% of my position. Lock it in as the market's giving to me. So not too bad so far, up 0.16%. Okay, Disney. These are my close trades. Now, this is a very good example of why it is important to have trailing stop mechanisms and to take profits when you have them, partial profits. I shorted Disney back here, $100.96 because of the rejection of the 200. Very similar to what I just showed you on UPS. So I shorted here, $196. I place my emergency stops 2 ATRs above. My end of day stop is just a close above the 200. All right. Next day, move down my way substantially, took off 2 profit targets. So I took off 20% of the trade, locked it in. The market can't take it away from me. Next day, moved down more, took more profits. So I'm reducing my position size. Now, it moved down to my 1.5 ATR trailing stop level, which means now if I have a close above a previous bar's high, I will lock in half. Well, that happened the next day. It closed above this previous bar's high after rejecting 1.5 ATR value. And at that point, I locked in about 1.5% gain, in addition to locking in the partial profits that I had. Make sense? So I'm reducing my position size, Next day went up, but it held above the 200-day moving average. Next day down again. I took more profit targets. Next day down again, took more profit targets. So now my position size is getting smaller and smaller and smaller, and I locked all these profits in because of the intraday partial profits here, a significant amount because we got to trailing stop level and then closed above. And then the next 2 days went ripping up. Was it a big deal? Well, I'm short. I would rather they not, but my position size was so small. Yesterday, on Friday, it did close above the 200-day moving average. So on the remaining shares, I had a loss of 1.44%. But because of the taking the partial profits, because of the trailing stop levels, this trade was still positive all in all for me, even though the remaining shares closed above my stop. Makes sense? So that's why it's important to have a process, take some profits, partial profits when you have them, have a trailing stop level. So yeah, the remaining shares I lost 1.44% on. No big deal, right? But it was probably only about 30% of my initial shares that I had. So even though the remaining shares ended up with a loss, the trade overall was a gain. So I hope that illustrates to you the importance of taking profits when you have them. Yes, when you have a big, large run up taking profits, you might think, oh, I wish I wouldn't have taken them. Yes, of course. But this chop mode, we only trend about 15% of the time. So the chop mode is important, and that's why it's important that I take partial profits. So this on the remaining shares here, minus 1.44%. Intel. Okay, this one was a loss. I bought Intel back here on the 24th at 29.66 because of the rejection of the 200-day moving average. Place my position size, place my emergency stop below here. My end of day stop is simply a close below the 200. Well, that's what happened. Very next day, closed below the 200, got out for a loss of $2.60. Then it moved sideways, moved back up over the 200, but I didn't take it because of earnings. right? I didn't take it because of earnings. Obviously, I wish I had, but I didn't know what the earnings were going to be. And now we're way back up. But that's the key. Look, I was in this trade for 1 day, and I'm very impatient. Yes, 2.6% loss, not fun, but I follow the rules, and that's the most important thing. And, if you would have held through earnings and gambled on earnings, you'd be like, woohoo, I made the right decision. Well, yeah, in some cases, but in other cases, you could lose a lot. Look at Amazon. If you would have held Amazon through earnings, then it reversed after earnings, you wouldn't be so happy. So, just my best advice, kind of a pro tip, don't be a gambler, don't hold through earnings. So, this one down 2.6% because it closed back below the 200-day moving average. Caterpillar. All right. I bought Caterpillar back here on the 10th with the close over the 200-day moving average. I got in at 213.68. I position size. I placed my emergency stop. My end of day stops closed below the 200-day moving average. Placed my 1.5 ATR trailing stop level above. Next day moved up, took partial profits. Next day nothing. Next day nothing. Next day partial profits again into the strength. Got to trailing stop level. Now, if I have a close below previous bar's low, I get out. That happened here on the 20th with a close under the previous bar's low. Locked in half of the remaining share, so everything positive and profitable. Down, up again, took some more profit targets. Down, down, but I exited here because the next day was earnings, and I exited here for a 1.19% move. Next day, earnings came out, went way down. I was like, whoa, I was glad I got out of that. No, sorry. What happened was earnings were, no, that's right. Yep. Got out there at 216.40 for a 1.19% loss. Then I saw earnings the next day morning, and then it reversed back down. Could have entered again here with the rejection of the 200, but I didn't. But all in all, nice trade. The remaining shares here up 1.19%. All right, let's get to the weekly bars. I like to trade multiple time frames, both daily and weekly, and of course I'm an intraday trader too. I bought IWM all the way back here on the 14th of October in 22, bought it at 167.19. On weekly trades, you make those on Friday because that's the end of the week. So I position size. Why did I buy? The rejection of the 300. I placed my 2 ATR emergency stop all the way below. My end of day stops closed below the 300 on a weekly basis. I placed my 1.5 ATR trailing stop level above. Next week went up, took profits. Next week went up, took partial profits. Now I'm in trailing stop mode, looking for a close below previous bar's low. Nothing happened that week. Next week, up again, more profits. Then we move sideways, no profits. Then we have our first close below a previous bar's low at 178.70. So half of the position I locked in 6.49%. Then we have a move down. If it had closed below the 300-week moving average, I would have got out, but it held. Then we had another big up move. Partial profits, lots of partial profits here. Then we had a big down move again, but it continued to hold the 300-week moving average on a closing basis. And look, all the way back here, rejected the 300. Here, rejected the 300. Rejected the 300. Again, this week, rejected the 300. So I could have added if I wanted to. I didn't. So the remaining shares on this particular trade up 4.71%. XLF. See, it's just the same process over and over. I bought XLF back here on 324 at a price of $30.71. Why did I buy? The rejection of the 250-week moving average. Position size, place my emergency stop 2 ATRs below, place my trailing stop level 1.5 ATRs above. If it moves up, I take partial profits. Next week, did move up. Took some profits off. Next week, nothing. Next week, moved up again. More partial profits. I'm in trailing stop mode, which means now that if I get a close below a previous bar's low, these are weeklies, so it has to be on Friday, then I get out of half. Well, this week at one point I thought, oh, I am definitely going to have to get out of half of my position, but I had to wait for the close, and it closed back above. Make sense? So this particular trade entry to current price on the remaining shares up 7.39%. Pretty sweet. AGQ. Shorted AGQ with this rejection of the 200-week moving average. Shorted at 34.60. Position size, placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level below. Not there yet, but this particular trade hasn't done a lot, but currently in the money 2.95%. My end of day or end of week stop in this case is just simply a close above the 200. Hasn't got there, so I am still bearish. If it moves down, I will take partial profits as I've discussed. If I get to my trailing stop level, then I'll go into trailing stop mode. So anyway, hasn't moved a lot, but up 2.95%. All right, had some closed out some trades on Pfizer. Pfizer really liked this trade with the rejection. I bought this on 421 at $39.92. Position size, placed my emergency stop below. My end of day stop or end of week stop in this case is simply a close below the 200. Well, that happened on Friday. Clearly it closed below, took a loss of 2.57%. And then Boeing. Last but not least, Boeing. I shorted Boeing here back on the 7th of April with a V1 to the downside and rejection of the 200. Shorted at 212.40. My emergency stop, of course, is 2 ATRs above my entry. My end of week stop is a close above the 200. So I shorted here 212.40. Next week went down significantly. Took some profits off the table, locked those in, didn't get to trailing stop level, and then a couple bars of sideways, but on the 26th of April was earnings, didn't want to hold through those, so before earnings, I just locked it in and locked in a gain of 5.08%. So just to recap, open positions, AMD up 4.15%. XLE up 1.56%. UPS up 1.16%. Closed out Disney for a loss of 1.44%. Closed out Intel for a loss of 2.68%. Caterpillar closed out with a gain of 1.19% on the weeklies. IWM up 4.71%. XLF up 7.39%, AGQ up 2.95%, closed out Pfizer for a loss of 2.57%, and closed out Boeing for a gain of 5.08%. All right, well, as discussed, let's do a little bit about trading psychology, shall we? Most important skill in trading, everyone. When it comes down to it, the psychological aspect of trading is the most important part. Putting together a process, a trading plan using good trading principles, not that hard. Really not that hard. If you've been trading for a while, you probably know that the most difficult part is following your process because your emotions get amplified with gains and losses. You're human. It happens, right? So I always like to talk a little bit about trader psychology because it is such an important part of trading. This comes from my good friend Steve Burns. You can follow Steve over on Twitter at @SJosephBurns. I studied under Steve for a couple years. Really appreciate everything Steve has taught me. A lot of what I am teaching here today is based upon Steve. So whatever Steve posts, keep your ears open, your eyes open, and read his post and follow him because he has really good content. Steve says, don't focus on your profits and losses. Focus on your signals. If you have an edge, profits will take care of themselves. And it is so true, everyone. You need to focus on risk first and your signals. Don't think you're smarter than the market. Wait for the signals, wait for the price action to confirm what you are looking for. Yeah, there are times where you'll just kind of run and gun it and you'll go, oh, this is much easier or much quicker. But listen, it's temporary. Just as many times as you win, you're going to lose. Wait for solid, verified rejections, solid, verified entry signals, whether those are rejections of the 30 RSI, whether they're V1s, V2s, 200, 250, 300s, moving average crossovers. By the way, in my one-on-one course, this is what I teach. I teach you all 5 of the different trading approaches that I use, and I will teach you step by step. But the key is focus on the signals. I will add focus on risk as well. Don't focus on your profit and losses. Focus on your signals. If you have an edge, profits will take care of themselves. Think about a casino, whether it's blackjack or roulette or craps or baccarat. They have a mathematical edge in all of those games. And that's why you have the big casinos, and that's why they make all this money, because there is a mathematical edge. They don't win every hand. They don't win every roll of the on the roulette wheel. They don't win every blackjack hand, just like you won't win every trade, right? But the key is, if you have proper signals, then you will have an edge, just like a signal. And if you have an edge, profits will take care of themselves. That's the irony. If you focus on profits, you're going to lose. If you focus on risk in your signals, you're going to win. That's what it comes down to. Look at trading as a marathon, not a sprint. One trade is just one trade. It doesn't matter. It shouldn't even get your heart rate going, right? If you position size properly, it should be boring. If you're looking for excitement, look somewhere else. Don't look for excitement in trading. Be methodical, rule-based trader. So don't focus on your profits and losses, focus on your signals. If you have an edge, profits will take care of themselves, and they will. If you position size correctly, use good trading principles, look at the long term of trading, that's how you make money. If you're trying to make money quickly, right away, you're going to have a hard time. The trading gods do not like this. So please, thank you very much, Steve Burns. Please follow Steve. I know you'll be glad that you did, at S. Joseph Burns on Twitter. All right, and then we are going to do a quick poem for my friend Franco D. You can follow Frank at Franco D over on Twitter. Please do. Please support him. He writes a poem every day, and it's always great, good information. And let's see what today's market poem is. A rudderless ship floats with the tide. Who knows where it takes you on an uncharted ride? But when opportunity meets preparation, good things preside. A plan and a map put success on your side. So let's break that down. A rudderless ship floats with the tide. Yep. There's no direction without a rudder. Who knows where it takes you on an uncharted ride? That's trading without a plan. But when opportunity meets preparation, that means doing your study, being patient, waiting for the market to get to the level that you want. Good things per side. A plan and a map put success on your side. Man, there's so much wisdom in this poem. A plan and a map put success on your side. What's the plan? Trading plan. Rejection of levels, emergency stops, end of day stops, proper position sizing, taking partial profits, looking for key resistance level, having a trailing stop methodology that puts success on your side. Thank you so much, Frank, and please support Frank and follow him over at Franco D. All right. Well, as I discussed at the beginning of the podcast, these are the potential trades that I am looking for next week, the levels that I'm looking for. They're not there yet. And if they don't get there, I'm not going to get involved. But if they do get there, then I know they're decent, strong levels where buyers should be coming in. And I position size, take that trade, place my emergency stop, end of day stop. I don't know if it's going to win or not, but I do know that if I lose, I know what my maximum allowed loss is going to be, and it's probably going to be pretty small. If I'm right, then there's unlimited opportunity to the upside, right? And the key is the winners have to be larger than your losers. That's the math. That's the calculus of profitable trading. So what am I looking for here on Alibaba? Well, Alibaba either wants to go straight up or straight down, right? So if I'm looking to buy Alibaba next week, what is the level? Well, the level that I'm interested in is a rejection of the 30 RSI. I don't know exactly where the 30 RSI is going to be. Well, actually, I do. I can use this tool here on Trade Navigator, for example, but I only know 1 day out. So 30 RSI would be right about here if it happened Monday. But may not happen Monday. I mean, that'd be a big move down, 6.87%. So who knows if this is going to get here? And I'm not going to get into this trade unless it does. Well, 30 RSI somewhere around in this range next week. I would need it to go under 30 during the day, close back above. That would be one option, or close under 30, close back over 30. That would be the other option. It would dovetail with this previous low over here. So again, wait for the market to get to the level that you want. So next week, if and only if we reject the 30 RSI intraday or we close under, close over 30, I would get interested in getting long Alibaba. Caterpillar. Okay, I am out of Caterpillar, as I mentioned earlier in the podcast, but what would be a decent level to get into Caterpillar? Well, the 200. It's too far above the 200 right now for me to get in. It doesn't give me a good risk to reward ratio. It may just continue up. I realize that. And if it does, great. Anyone in Caterpillar, glad for you. But I would like next week looking for a move back down and a retest of the 200-day moving average, giving me a better risk to reward ratio. This is very bullish that we've got above the 200, but it's a little bit chasey right now. If I bought right here, my end of day stop would be a close below the 200. It's a bit too pricey. It's a bit too far. I would like to see it move back down, retest that 200, give me a good risk to reward ratio. That is what I'm looking for on Caterpillar. Etsy. I've been talking about Etsy for a long time, ever since it was up here. And I said, look, if we get a rejection of the 30 RSI, I would get in the trade. It hasn't rejected the 30 RSI, but look, we have earnings on the 3rd. If the earnings are bad, then we definitely could go way below the 30 RSI. If they're good, they'll probably take off and I just won't take the trade. But what I'm looking for specifically is a rejection of the 30 RSI after earnings. If it happened 2 days before, I probably wouldn't take it because then I only have 1 day in the trade. If it happened 3 or 4 or 5 days before, then yes. So earnings here on the 3rd. Let's see. The 3rd is, oh, that's Monday. Is that right? January, February, March, May. 3rd. Oh, that's April. Oh, that's Wednesday. Okay, so if it happens before Wednesday, I'm not going to take the trade. But after it has earnings, if it rejects the 30 RSI, I will take the trade. What I like here on Etsy, see how we have the low here? See how we have the deep red MACD bars? This is showing a lot of selling momentum. Then we rallied, obviously. Now we are back lower than this low. But you see how there's no red here? That is called a double bottom with a bullish divergence and a missing right shoulder. It's showing that the first move down had stronger momentum than the second move down by virtue that there is no red. Again, this is what I learned from studying one-on-one with Dr. Alexander Elder, and this is basically what it means is you're running out of sellers. And the implication is if you're running out of sellers, that the market's going to go up. Because when you run out of sellers, that's when things go up. When you run out of buyers, that's when things go down. So we do definitely have a double bottom, bullish divergence, missing right shoulder in place at the moment, but I still need that entry trigger. And the entry trigger would be an under 30, over 30 after earnings. Lockheed Martin. All right. Well, as I do in every podcast, I identify the level, and if it gets there, I take action. If it doesn't, I don't. Well, this 200-day moving average down here, that's a key level. That is where buyers should be coming in, and there will be some buyers coming in, and it would give me the context for a good setup with a good risk to reward ratio. Will it get down here? I have no idea. But if it does and bounces at the 200 with a good risk to reward ratio or an intraday rejection of the 200 or a close under, close over, that's my entry point. Now I have a nice line in the sand to position size from and to key off, giving me a good risk to reward ratio. And a good risk to reward ratio, that is what it's all about in trading. Now, I like also to look at multiple time frames. So I drew the green line here at the 200. Why did I do that? Well, I'm going to go to the weekly, and you can see that the green line was the 200 on the daily. How does that stack up on the weekly? Well, look, we have the support of the 50 EMA underneath us. We're inside of this big bar. I like that level. It makes sense. It's important to look for support and resistance on multiple time frames. And again, on the daily, we have the 200 just by itself. That's a good level to look at. On the weekly, that 200-day moving average level, the green line, dovetails nicely with support of the 50 SMA above. Sorry, 50 EMA below. All right, so that's the level that I'm looking for. And I mean, obviously buying up here, not such a great idea, right? Which brings me to the point, everyone. The market, we've had this big rally. I see some danger zones, some warning signs of what's going on. And after I show you the trades here, we'll cover the indexes a little bit. But, in all my training and teaching that I have learned from my mentors, who are some great mentors and teachers and traders, is that you want to buy at least in value. The value zone is between this green line and this green line in this channel. Buy in value, sell above value, or buy below value and sell in value. What most amateur traders do is they buy above value and then they get stopped out in value. Anything above the green 1ATR channel, I consider above value. I don't want to buy in here. And right now, the market, although strong, certainly with the last couple days, we are very much above value. We're getting into some RSI levels and some resistance. So I guess my best piece of advice here is be careful as far as getting long here in the general market. We've moved up strongly, and in my experience, this is the area where we will come back down. Buying dips, buying deep dip buys, in my experience, is the best way to make money using a good risk to reward ratio. So just a little bit off the cuff there, but did feel a little bit moved to tell you, be careful. And I will show you, we'll look at some of the indexes after we look at the potential trades for next week and why I'm saying that. But again, back to Lockheed Martin, LMT, looking for a rejection of the 200 next week. If it doesn't get there, then I don't take the trade. If I do, then I will definitely consider taking the trade. Rio Tinto, okay. Nice little close under, close over the 200. Now we have the 200 as as support. Would have been a good trade so far. Would have been profitable. But what I'm looking for is a retest of that 200, giving me a higher low rejection of the 200. Here we have a lower low, close under, over. Yeah. But a lot of times the lower low, close under 200, over 200s or 250, 300s move up, and then they tend to come back down. Buying a higher low V1, V2, buying a higher low rejection of the 200, always a better idea. So, Rio Tinto has come down significantly, but next week what I'm looking for is just another rejection, either a higher low close under over the 200, a bounce at the 200, or an intraday rejection of the 200. And let's take the line here, 62.82. We go to the weekly. That dovetails nicely, super nicely, with the support of the 50 SMA on the week. See, using the multiple time frames, looking for support levels on multiple time frames. The support level on the daily is the 200. There's the green line. Support level on the weekly is the 50. See how we have two levels of support. So on Rio Tinto, looking for a pullback and giving me a higher low retest of the 200. That's where I would get long. Same thing with United Airlines. I know one of my students, Gene, just bought this on Thursday with a close under, close over the 200, and a V1. Very nice, Gene. And it moved up perfectly. Now, honestly, I want this to keep going up for Gene. However, if we do come back, test the 200-day moving average, that's where I would get in. I would not get in here. If I was in it, fine. But to enter a new position here, the risk to reward ratio is not good. Here's the green line at the 200. Let's go to the weekly. Again, that level dovetails nicely with the 50 weeks. So nice job, Jean. She did exactly what I taught her, and I was glad to see that. So on UAL, if and only if we get a pullback and retest of that 200, I will get long. UUP, which is the dollar. Very important thing here. You see the highlighted bar here. This is called an abandoned baby. Crazy, right? Why does it? Because it's abandoned. The left, you see the gap we have to the left and the gap we have to the right, so it's kind of hanging out here in space, also called an island reversal bar. Very strong, and this indicates a significant bottom. I can show you the same over here. Abandoned baby. Look at this. See, gap to the left, gap to the right. This is a bearish abandoned baby. And did that nail the signal? Man, I would say so, right? And now this is a bullish abandoned baby here. And when the dollar is strong, that is generally bad for the market. When it's weak, it's generally good for the market. This is showing that it is strong. But why do I bring this up? I bring this up because if we pull back and test this high of the abandoned baby, I would definitely get long. My stop would be a close underneath it. So I am looking to get long if and only if we come back and retest this high and reject it, meaning it goes down and then bounces back off. It gives me a good risk to reward ratio because my end of day stop will be a close below this bar. But bigger picture for the market, this is strong for the dollar. I know a lot of people are talking about the weak dollar and how it's going to crash and all this. Maybe, but the technicals are telling you something different. So that's what I'm looking for. If and only if we come back, reject the high of this abandoned baby, I would get long, giving me a good risk reward ratio. VIX, wow, man. I mean, I have been trading for so long. Look at the volatility. No volatility whatsoever. Down, 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 sideways. Before earnings came out, there was a bit of volatility and it went riding up. But everyone hates VIX, which makes me like VIX. Right? Look what's going on. We have a double bottom and a bullish divergence. Look at the low, deep red MACD bars. We rally into some green. Now, is this lower than here? It certainly is. Are there any red bars here? There are certainly not. Again, that's a double bottom with a bullish divergence. But that's very, very bullish. You look at this and go, how is that bullish? Well, it's bullish because this first move down with the deep red MACD bar showed strong selling. Then we had a rally. Now we're lower. But from the MACD math, it's not as strong as this. That's why you're not seeing any red. This is very bullish long term, which is bearish for the market, right? So we have the dollar, we have VIX with the bullish divergences. Yes, the market's going up, but that's why I was saying please be careful because there's a lot of signals behind showing that we are near a top. And so I love VIX here, but I have to look for a valid entry signal first. What's my valid entry signal? Well, we're at 35.78. More than likely, it's going to continue down. But if we can go down and intraday reject that 30 RSI or have a close below 30 and above 30, I would definitely get long because that's a valid signal by itself. But in conjunction with this double bottom bullish divergence here, it makes it really good. So what I'm looking for on VIX because of the double bottom bullish divergence is an under 30 over 30. So quick recap. Alibaba, and again, on all these trades, only if these signals happens will I take the trade. I'm looking for an under 30 over 30 or some kind of rejection of the 30 RSI. That's what I'm looking for next week on Alibaba. Will not get involved if it's not, but an under 30 over 30 on Alibaba. Caterpillar, looking for a pullback and retest of the 200 that gives me a better risk to reward ratio. Etsy, we have earnings on Wednesday, but I'm looking for an under 30 over 30. Lockheed Martin, I'm looking for a rejection of the 200. If it gets there, it may not, but if it does, that's what I'm looking for. Rio Tinto, looking for a retest of the 200. United Airlines, looking for a retest of the 200. Dollar, looking for a rejection of the high of this abandoned baby, and VIX looking for an under 30 over 30. Now, I do want to point out here what I have 8 signals. It's possible, theoretically, that they could all trigger on Monday. Does that mean I would take all of them? No, I only take one trade per day. I only take the best trade of the day. So hypothetically, if all these trades triggered on Monday, I still would only take one. And how would I decide it? Well, I'd look at the risk to reward ratio. I'd look at the multiple signals. I'd look at multiple time frames to see, okay, which one has the best support on multiple time frames. So just want to be very clear on that. And I think there's a lot of wisdom in just narrowing down to the best trade of the day, even if you have 5 or 6 or 8 that triggered. So that's an important concept. Okay, those were the dailies. Now we're going to talk about the weeklies. But before we talk about the weeklies, I just want to quickly go over the major indexes and show you what I am seeing. Okay, and this is why I'm being a little cautious and careful about this market to the upside. Look, here are the Qs, QQQ, NASDAQ 100. Do you see the high we have here? Do you see the high MACD bars we have? This showed that there was a lot of selling. Then we pulled back into some red MACD. And now we are higher than over here. See how we broke out above this high? But is this confirmed by any green bars to the upside? No, not at all. This is called a double top with the bearish divergence and a missing right shoulder. It's showing you that this move up here from a MACD perspective did not have the strength of this move. So it's indicating, it's implying that we are running out of buyers. And what happens if you run out of buyers? You go down. Now, just because we have a double top and a bearish divergence doesn't mean you immediately short it, but it's a warning sign. It is a warning sign. Additionally, look at the top over here. See how we're at the third ATR channel? Now we're higher. We're above the 1. So we have a double top with the bearish divergence. We have a double top. We have a MACD divergence, meaning this got up to the 3rd. This only got a little bit above the 1. These are all divergences. Look at the RSI here. RSI got up to 70. Now we're higher. We're not there. So we have a triple convergence here. This is what's concerning me about the market in general. And that's why I'm saying please be careful as far as letting FOMO and all this excitement in the market turning up, because from a technical standpoint, it looks like we're running out of gas, even we're moving up. Okay. Same thing with SPY. Double top, bearish divergence. Here's the high. Green bars, we pulled back, obviously. We're higher now, no red bars at all to be seen. RSI divergence and also ATR divergence. So please be aware of that. UUP dollar, I told you about the abandoned baby here. This is bullish for the dollar, even though the narrative out there in the market, this dollar is really weak and it's going to crash. Well, this abandoned baby tells me differently, and a strong dollar is bad for the market. Okay, and lastly, VIX, yes, going down, but we have a bullish divergences here. So everything is telling me that we are near a top. So please keep that in mind. Don't adjust or start shorting because I said this, because again, just because you have these double tops and bearish divergences doesn't really matter. But if you get a signal to the downside, then they do matter. Okay, so just as always, be careful, but keep in mind that a lot of these technical signals here are telling us that we are running out of buyers. All right, now let's go to the weekly. Again, weeklies happen on Friday. That's when the bar closes. Here is Anheuser-Busch. Okay, all sorts of news about Anheuser-Busch and all sorts of controversy, right? Well, yes, Anheuser-Busch has come back down, but from a technical perspective, this 200-week moving average here, I really like it. I really, really do like it. If we pull back and reject the 200-week moving average on Friday with an intraday rejection or a bounce or close under, close over, that would get me long. Let's take a look at the level on the 200 here is on the week. Let's go to the higher time frame. This is a green line. Transpose it onto the higher time frame inside this big up bar. I like it. It makes sense. So potential for next week, if we get a bounce or an intraday rejection of the 200, I would get long Anheuser-Busch. Etsy, we talked about Etsy on the daily. I've been talking about getting down to the 300-week moving average all the way up here. I was patient. I could have taken this trade on Friday, yesterday, because of the intraday rejection of the 300. But earnings are next week, so I'm not going to do it with a couple days before earnings. But after earnings, if it goes down and rejects and closes back over the 300, I think that would be an excellent spot to buy. It may gap up and I don't care about it. But after earnings, which are Wednesday, so Friday, earnings will be behind us. And if it has rejected the 300, I think it would be a really good risk to reward ratio. GDX, gold miners. Well, we have had this huge move up. It's just normal course of business to have a bit of a pullback. The pullback would be the 200-week moving average. So if I had a bounce at the 200 next week or an intraday rejection of the 200 next week with a good risk to reward ratio, I would consider getting long gold. Alphabet, Google. Okay, well they had earnings. Wasn't super move up, but Alphabet did move up with the rest of the market. Alphabet on Monday, yesterday, was down 25 cents, so it's showing a little bit of relative weakness compared to the rest of the market. This is the level that I am interested in, is the 200-week moving average. Will it get back down there? I have no idea. It's probably unlikely, but if it does, it offers a good risk to reward ratio. So that's what I'm looking for next week, a bounce or intra-week rejection of the 200, giving me a good risk to reward ratio. Nike. Okay, Nike. 200 has acted, 200 week has acted as support. We are above it. Would I buy it here? No way, because it's a horrible risk to reward ratio. But next week, if it does come back down, bounce at the 200 or intra-week rejection of the 200, that's where I would get long. Pfizer. Okay, well, I had that losing trade on Pfizer. We do have earnings coming up on the 2nd, I guess, which is Tuesday. So I think that's going to be a very good opportunity. If it gaps up, okay, then I'm just out of the trade. But there's 3 levels that I'm looking for here. 200-week moving average, 250-week, or 300, or a 30 RSI level. So I don't want to get involved right before earnings, but after earnings, it's going to tell us a lot. If it reject under 30, over 30 after earnings, that would be a potential. A intraday rejection or bounce at the 200-week moving at 300-week moving average, also a potential. To the upside, if it closes above, a nice gentle close above the 200, then that I would get long again. But have to get earnings out of the way and then see what happens. So I'm looking after earnings. If we reject the 30 RSI level, that's a potential. After earnings, if we reject the 300, potential, 250 potential, 300 potential. Tesla. Okay, I have been talking about the level that I like on Tesla for several weeks now. It's this, let's see, it's the 250-week moving average. If we reject the 250 next week, that's what I'm looking for. If it goes lower, of course, I could also get involved at the 300. But the real level that I'm looking for next week is some kind of bounce or rejection, the 300. And then last but not least, back to VIX on the weekly. Look at this chart. But look, there's divergences on the weekly as well. Look at the low. Look at the deep red MACD bars. Then we rallied strongly, got into green MACD bars. Now look, we are lower than over here. No red MACD bars. We're at a 31.27. So very likely, if we continue down next week, we're going to go under the 30 RSI and then possibly close back above. So I know this looks horrible. Who would ever want to buy this? Me. because of the indicators that are happening here, right? And clearly it's overdue for a bounce. We're historically low on the VIX, but I can't make my decision based upon that. I have to make it on a legitimate entry, and the legitimate entry would be an under 30, over 30. I would definitely get long, especially in light that we have a double bottom bullish signal. So real quick recap on the weeklies. Budweiser, BUD, looking for some kind of rejection of the 200-week moving average with a good risk to reward ratio. Etsy, looking for after letting earnings go by, under 30, over 30, or rejection of the 300. GDX, gold miners, just a pullback and rejection of the 200. Alphabet, looking for a pullback, rejection of the 200 week. Nike, looking for rejection of the 200 week. Pfizer, let's let earnings get out of the way. And then all sorts of levels here to contend with. Under 30, over 30, 300, 250, 200 week. Any of those giving a good risk to reward ratio. Tesla, pull back to the 250. And VIX, looking for an under 30, over 30. And again, everyone, looking, these could all potentially trigger next week on Friday, but I'm not going to take them all. I'm only going to take the best one of that week, narrow it down to the best one. So, I talked earlier about that I do offer private one-on-one lessons in the evening time. I teach a great course. It's 15 hours. It's one-on-one. It's just you and I. It's the best way to learn anything is learning it one-on-one, because then you get the full attention. You can ask as many questions as possible. You should really consider taking this course. 15 hours one-on-one instruction time. I can teach you a lot. And we go through and I teach you all 5 of the different trading approaches that I use. I teach you step by step. It's very important to me that my students succeed. Extremely important. It's one of the reasons I started this channel. I want to see people succeed in trading, and I have the experience and the skills to teach you. I am a good teacher. I've been taught that by all of my students. I'm very patient, but consider the course costs $1,750, but it's an investment. It's worth every penny. And if you're interested, just send me an email. My email is in the link of this description. If you do write me, say, Greg, I'm potentially interested in taking your course, I will say, hey, that's great. Let's do a Skype call. The Skype call is free. It's not a sales call. I just want to learn more about you, your trading, your challenges, and your trading goals. It's a great time for you to ask me questions about the course. And when we're done with the call, then it's totally on you. If you want to reach back out to me and say, yep, Greg, I want to take the course, all you have to do is resend me that email. We'll get it set up, and you will be glad that you took this course. You will learn so much. I teach people from absolute beginners to people that are in the hedge fund industry. So wherever you are, doesn't matter. I'm ready for you, and I will teach you a lot. Now, if you like online courses, I have a great online course available at udemy.com. The link is in the description of this link. It's the deep dip buy. This course is called the Deep Dip Buy Stock Trading Strategy. It only costs $12 or $15, but there's a ton of content. There's 9.5 hours of video. There's 26 video. There's 15 study guides, and I teach you step by step how to get started trading the deep dip buy approach. And a lot of the trades that I showed you today were deep dip buys. I have sold so many of those courses around the world, got such good reviews, such good feedback. It's a great place to start. Not as good as the one-on-one, right? Because I teach you the 5 and you have me personally. But if you want to get started with something that's less expensive, that would be the place to do it. 12 or 15 bucks. If you like today's podcast, I would certainly appreciate it if you could hit the thumbs up button. It does really help the channel, lets YouTube know that there's some valuable content here. And if you've learned anything or found anything valuable today or in previous podcasts, I would really appreciate it. Just hit the thumbs up button or subscribe if you haven't subscribed, or share it on social media. That would all be great. And then last but not least, and the most important, please go out and do something nice for someone today. One nice random act of kindness would really make this world a better place. In addition to that, I am a huge animal lover. I grew up with so many animals, big part of my life, and they appreciate acts of kindness as well. So, if I could implore you, please consider doing one nice thing for another human being today and one nice thing for an animal today. It's just good. It's good karma. It will come back to you. and I just think it's a good policy. So have a great rest of your weekend. Hope you've been trading well. Please be safe out there. Don't get caught up in the FOMO and the moving up for the reasons I explained earlier about all the divergences and so forth going on. Stock market doesn't go straight up, so please be careful. We're kind of in a precarious level here, so please keep that in mind. If you have any questions or comments, please put them in the comments section. I'll do my best to respond to them, but I appreciate you spending the time. Hope this was helpful. Have a great rest of your weekend, and God willing, I will see you next week, and we'll see what happened the coming week. Should be interesting. All right, take care, everyone, and on the way out here, I have to run the U.S. legal disclaimer. Thanks again for your time. Bye-bye.
U.S. government required disclaimer. Futures and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.